Good evening, everybody. It is Thursday, September the 29th. With so much to talk about in the market, I really just don't have any words. Let's talk money. Let's talk market wrap up. All right, everybody. So first of all, thank you for tuning into the channel once again. I want to hear what you have to say today about the markets and what I have to say. Comment down below. I want to know your thoughts. Do you think inflation is going to be a continued problem well into 2023? Or do you think that the Fed will eventually get it under control? But let's jump into today's market. Actually, let's briefly touch on yesterday. So yesterday we saw the markets move quite aggressively to the upside. We saw the 10-year yield absolutely plummet over 6% by the close. But today, that euphoria that we experienced in the market yesterday, like I said, would probably dissipate very, very quickly, did. And in fact, if we take a look at the markets today, the Dow was down over 400 points. Tech also down about 314. The S&P was down about 75. Overall, the markets did absolutely miserable. But the big thing, did you see the 10-year yield? Although it did go back to the upside over 2%, actually 2.25%, that is a relatively calm move considering how much it dropped yesterday and how poorly the markets did today. That tells me a couple of things. Number one, everything that the central banks are trying to do with all the money printing and all the buying, it wasn't enough to keep the sentiment out of the market and the market pulled down further. Number two, this might be the active traders out there. And I'm not talking about people who are actively trading from their laptops, but I mean the big traders out there are sending a message to central banks around the world to follow suit with the Bank of England. And previous to that, the European Central Bank. They're telling central banks that they need to start quantitative easing or the markets will continue to fall. The other thing I want to point out today is the US dollar also slid today. Nothing too significant, but it did drop, currently sitting at about 111.5. But what does this mean overall? Well, economic numbers continue to be fairly negative. Yes, job numbers in the US were slightly better than expected today. However, on the flip side of that, we're finding that more and more people, and as far as affordability is concerned, is getting significantly tougher for the average Joe. The average American, the average Canadian, the average European, it doesn't matter. In fact, if we take a look at the German numbers that came out today, German inflation hit double digits, and some people are saying that's why the bonds were being sold off today, and why we saw that uptick in bond yields. Well, maybe. I really don't think that's the case. You see, the issue with inflation in Germany is no specific nation concern. In fact, it's global. This goes across every country at this point, because it's not just an issue with inflation. You see, as countries continue to print, as countries continue to fund wars, as countries continue to fund crisis after crisis, this money has to come from somewhere. And although it leads to inflation, that essentially leads to a devaluation of currency. You see, it's not just an inflation issue, it's a currency issue. And the problem with that is over time, and it's created by design, currency will eventually collapse. And that is a major issue. Overall affordability for the average Joe will continue to drop. You can expect that. Overall, housing numbers will continue to drop. Values of homes will continue to drop. I've been seeing out there, I've been seeing some real estate analysts out there saying that by 2023, expect the residential real estate market to bounce. And although, yes, traditionally we do start to see certain things and people like to settle their contracts and go into the holiday season knowing that their house has been sold or a house has been purchased. They like contracts to be wrapped up before they enter the holiday season. But I think a lot of people are basing their opinions on previous trends, not really focusing on the actual numbers and how very, very different this round is compared to previous recessions and previous housing pullbacks and previous economic downturns and previous stock market pullbacks. And that's a major problem because you have to look at everything in this particular market at the macro level and come down because it is very, very different this time. Just take a look at your portfolios. Your bonds, which typically are supposed to help buoy your portfolio in a downturn, are taking a beating. At the same time, the equity components of your portfolio are taking a beating. GIC rates and guaranteed interest rates are starting to move up quite aggressively as interest rates also go up. It's reminiscent in a way to previous recessions, but at the same time, we have a perfect storm of every other economic factor starting to slip. And then we also have propaganda telling us that what we're seeing with our own eyes is false. Trust what you see. Don't trust what you hear anymore. It doesn't matter what Motley Fool might be telling us as far as the economy is concerned. Actually, I think they're pointing out some good valid points today, if I'm not mistaken. And I'm just using Motley Fool because I just saw them up on my screen. It could be MSN. It could be MSNBC. It can be Bloomberg. Here in Canada, it could be BNN. It doesn't matter who the media outlet is. Start using your eyes and thinking. Start looking at the bills that you pay. Start looking at your grocery bill. Start paying attention to your gas tank. Because at the end of the day, the currency is dropping. The value is disappearing. The US dollar, fine, short-term bounce here, but this isn't going to last forever either. Keep in mind, there is a savior coming. It is called the central bank digital currency. When it'll come, I don't know. Will we have a currency collapse? Absolutely. It's inevitable. Will we also see dramatic downturns in the financial system themselves? Absolutely. Again, it's an inevitability. When? I don't know. You see, right now, central banks are doing everything they can to prop up everything artificially, and they're not done yet because they need to be the buyers and sellers of last resort, and they'll continue to do so until they can't. In the meantime, you and I will feel this. That's it, everybody. I think for tomorrow, here's what we'll take a look at. Today, we saw a little bit of that negative rally or a negative downturn, I should say, far from a rally. And it continued to accelerate throughout the day. Yes, power hour did pull back off the highs, roughly 150 points or so off the lows, I should say. But we still have significant downside momentum. The news from the UK and the England, the Bank of England was not enough to support the markets and keep it moving to the upside. If other central banks begin to do the same, then we can anticipate a little bit of a rally here. But I think nothing major unless the US central bank, the Fed, is ready to pivot. And right now, it doesn't look like they're ready to do so. That's it, everybody. I will see you tomorrow morning at the opening bell.